So, of course, I'm Austin Nold, the senior wealth planner here at Nold Bryant. And with us today, we've got Christian Bryant, who is a CFA, and he is the chief investment officer of Nold Bryant. And then we're proud to have Steve Colano, the chief investment officer of Integrated Partners. We collaborate a lot with Integrated, discuss portfolios. Integrated's got a lot of their own portfolios, so we work together. So I think we're just going to get started with Steve, just talking about the market. If anybody has any questions as we go along, feel free to shoot us a message in the chat. And then at the end, if we have time, we'll also have a question and answer on anything you guys might have questions on. So, Steve, we'll
And I
turn
guess
it over to you.
little quick background on Steve as well as Steve, you've been at Integrated for what, 2 or 3 years now?
Yeah, it was two years, June 1st. So yeah, a little over 2 years.
And then prior to that, he was the chief investment officer for a $30 billion investment firm. So he's done a ton of institutional asset management, and he's got a great background in the industry. So looking forward to learning from him today, along with the rest of you.
Yeah, appreciate that, Chris. I'll send you the $500 check in the mail after the call. But as always, it's always fun and great to get together with you and your clients, talk markets and the economy, and see if we can get a sense of where things might be headed. So with that, I'm going to share my screen, and hopefully it comes through together okay. And I'm going to make it a little bit more visually friendly in 1 second. Hopefully, does that you guys tell me, does that come through okay?
Looks good to us.
Awesome. All right, great. Well, I always like to start, as we have talked in the past, kind of where we've been coming from, and I thought this would be an interesting one to start. This is a slide that shows, in terms of talking about where things are going and forecasts and predictions and all that kind of good stuff. We remember coming into the year 2023 how much negative sentiment there was coming into the year 2023, how bad of the recession was going to be, not if but when there was going to be a recession. And this shows, in relation to the S&P 500, if you looked in December of 2022, these are all the projections for where the S&P 500 was going to finish at the end of the year in 2023. Those are all in red, and then you can see actually where the S&P 500 actually finished the year in 2023 is the one in blue. So well ahead of any of the initial forecasted projections starting out the year, and just kind of we blew through any kind of assumption of recession, et cetera, despite the negative sentiment as we rolled into 2024. And the big question around 24 is, all right, can it keep going? What's 24 going to go? What's going to be like? And so actually, if you compare that to, here's where we are today. So similar kind of chart or table. This looks at what the current year-end projections are for the S&P 500 for the year end of 2024. All the individual strategists and investment banks are listed, but down the bottom is kind of a quick summary. So right now, the average year-end projection for the S&P 500 is 5243, and you can see this is these stats are from about a week ago. So at that point in time, the S&P was at 5432. I just looked before getting on the call. We're at about 5440 to close out the trading day today. And actually, if people realized, last week, we actually hit an intraday all-time high on the S&P 500 of 5504. Last Thursday into Friday, last Thursday, excuse me, with the markets being closed on Wednesday. So again, kind of the projection. There's one 6,000 projection out there, but by and large, for the most part, the projections for the S&P 500 so far have undershot where the market has been already so far year to date. It's been, we're looking right now year to date up somewhere between 14 and 15% in the S&P 500, relatively broadly. It's been an interesting ride so far year to date. I'd say probably the biggest change from the beginning of the year to now has probably been explained by, I think, this chart here. This also going back to December of 2023, so at the end of last year. This is a survey that we pay a lot of attention to from Bank of America Merrill Lynch. It basically asks advisors, investment banks all over the country what their expectations are for, in this case, short-term interest rates. And so you can see, compared to history, in January of 2024, when this survey was taken, so kind of end of the year 23, beginning of the year 2024, what people's expectations were for lower interest rates in the next 12 months in 2024, it is literally off the charts going back to 2000 in terms of almost over 90% of the respondents like, yep, we are definitely going to have lower interest rates in the next 12 months as of January 2024. And probably, yep.
Go ahead. Steve, well, sorry, maybe I should have let you finish this chart, but going back to the previous one, even as you're addressing this too, we did have a question about why do we see the question was, why do we see such a delta between the different firm projections? How can they vary that much?
Yeah, great, fantastic question. Each firm does their projections a little bit differently, but by and large, there's usually, to be honest, having done this in my previous life, as Christian mentioned, so my previous life has 20 years at BNY Mellon. So we did all of the expected returns and projections for BNY Mellon. Most firms, there's usually literally a calculation for your projection of, in this case, the S&P 500. And it's always whatever multiple of earnings you think, and then what the earnings actually are. So oftentimes, they're taking either bottom-up analyst expectations for each of the companies in the S&P 500, or they're working to an overall earnings number for the overall index based off of what they think sales growth is going to be for the overall index, what they think profitability or profit margin is going to be, and that would work to an earnings number. And then based off of their interest rate projections, they're going to put a multiple of earnings on that earnings projection. So in the case right now, if you were to say, okay, right now the expected earnings for the S&P 500 in aggregate for 2024 per share are roughly $240. And so if you said, okay, now 23 times $240, that gets you into I don't have my calculator in front of me, that gets you probably close to where we're trading on the S&P 500 in terms of 5,400. So in by and large, it's always some estimate of what the multiple or what the earnings are going to be per share for the overall index, which is an aggregate up of all the earnings underneath all the 500 companies, and then a multiple based off of a price to earnings multiple off that index number. Why are there so many deviations? Usually there's different kind of sales assumptions, there's different profitability assumptions amongst all the firms, different multiples based off of different interest rate expectations. So all the variables that go into it can be different amongst all the firms, but that usually is the rough formula for how projections are being forecast at the beginning of the year. When you see those projections being updated throughout the year, usually what's happening is, in this case, the first quarter earnings were much better than expected for actual versus estimated earnings. So you'll see a lot of firms update their earnings forecast for the rest of 2024, and with that usually comes usually an updated number for the overall index projection. So a great question. That's usually kind of what it is. It's a relatively straightforward formula with a lot of important assumptions underneath that can move around. But again, and usually it's so far we've been better than most of the estimates have projected in terms of where we are in the S&P 500 at last week an intraday all-time high, and then getting back to kind of.
Since we're on that subject, I guess I'm going to go ahead and say, I'll interject again. Well, I'm taking
totally.
more time. We were shooting for 20 minutes and we're already probably pushing you up. So should we be concerned? I'm sure this is going to be on a lot of people's minds since most of those estimates are lower. Should we be concerned about the estimates being lower than where the market is now? If that's kind of a general consensus of things being lower.
Yeah, no, it's a very fair question, which I probably point back to this one of like just keeping in mind of where projections were, and yet the market just kept going higher throughout 23. And so far, what we've seen in 24, even though some of the projections are lower, we continue to see so far in the first quarter, earnings are better than expectations. And so far, we're coming now to the end of Q2, and so we'll start to see estimates, or we'll start to see actual earnings reports from the second quarter earnings probably come time midway through July or so. I think it's an important point to raise now to the question is, at the end of the day, corporate earnings are what drive equity prices. It is 100%. And there's a chart that I can maybe share afterwards. It's not in this deck, but it goes back to 1926, and it shows the price of the S&P 500 in comparison to trailing 12-month earnings in this case. So not so much what expected earnings are, but just what earnings have actually been. And the two lines are literally on top of each other for, coming up on 100 years. But at the end of the day, remembering that equity prices reflect earnings and earnings growth and what earnings actually have been. Related to that, I think right now what's been positive is earnings have been better than expected in the first quarter. Right now, we're starting to see better than expected earnings expected in the second quarter, and probably importantly, and this gets to where some of the opportunities are in the market that we'll touch on. I think actually I'll jump there right now. I'm going to jump forward. This is a slide that shows kind of the year to date performance of the S&P 500, which to date as of about a week ago, so roughly up 15%. And importantly, what the story of this year has been similar to what we saw a lot of in 2023, the market concentration. So the markets have been led higher by a very few number of stocks, in particular the Magnificent Seven, which are Meta, Google, Microsoft, Tesla, Facebook, Nvidia being the granddaddy of them all. But those 7 stocks constitute almost 35% of the S&P 500. So about roughly a third of the S&P 500 is comprised from just those 7 stocks, because those companies have gotten so big in terms of the market cap. And so as you can see in this picture, the Magnificent Seven, which is in the light green, on a year-to-date basis so far this year, they're up 32% compared to the rest of the 493 up just 6. So in terms of the year-to-date performance of the S&P 500 up 15%, almost 70% of that return has been generated by just 7 stocks. So and another way to look at it, roughly just 17% of the stocks in the S&P 500 have actually done better than the index itself. So the breadth, so how many stocks are actually doing well, has been very narrow. Oftentimes that can be a sign for a fragile market. So this gets to your question, Austin, around should we be nervous? What we're anticipating, and I think where the opportunity lies in the markets right now, is if you look in the upper right-hand corner of this same slide, you can see what I've circled. These are by quarter the expected earnings growth for both the Magnificent Seven, which is in green, and then the remaining 493 stocks or companies in the S&P 500, which is in blue. So you can see what's been happening is the earnings and the earnings power of those 7 stocks have kind of been carrying the market. What we see going forward, especially as inflation and interest rates stabilize and at some point start to come down based off of expectations for interest rates to come down, whether it be this year or even early next year, a lot of those companies being more cyclical start to generate positive earnings growth. And so what we're expecting right now, where you can see what the market is expecting in terms of expected earnings growth, is that the remaining stocks in the S&P 500 start to catch up and even starts to surpass those 7 stocks in the S&P 500. So don't necessarily need those to trade lower. They just kind of tread water while everything else catches up. And we see that's probably one of the more exciting and broader opportunities that continue to see this market move higher, which is why I don't obviously never want to say never have a concern, but why I'm less concerned with the lower earnings numbers now is because there's still broad opportunity for those remaining 493 companies and even small cap stocks to start to catch up to. We start to see a much broader and wider participation in the market as the economy starts to reaccelerate, if not even keep going, in the face of kind of, I'll say, lower interest rates, even again later this year or early next year.
Yeah, and that's great. Christian, go ahead, Christian.
Yeah, I was just going to add it. So I would say that kind of makes the case too for going forward why you don't just own the S&P 500 index. So much of the return has been driven by these few stocks, and so then so much of the S&P is that it's composed of these small number of stocks. But going forward, one of the things we do a lot of is sector rotation. So if you think about the sectors of the S&P, technology and communications and energy and financials. Well, year to date, at least last I checked, I think technology and communications are the only 2 sectors that are outperforming the S&P out of the 11 sectors in the S&P. So
a great, sorry to interrupt on that, Chris. So a great point, actually. And what's one of the interesting things on so much of it driving the 7 stocks to have the performance they have been is just, as probably everybody's seen and heard, et cetera, the euphoric optimism around artificial intelligence. What's interesting, and that's where a company like Nvidia that makes semiconductor companies that actually make semiconductors to train other semiconductors to perform artificial intelligence is just booming. What's been interesting is you're starting to see that same, I won't say euphoria, but optimism work its way into the broader economy, because it as of this week, it's not. But if you looked at the utility sector about a week and a half ago, it was one of only the 3rd sector to be doing better than the index, better than the S&P 500, which always people like utilities. It seems to kind of be boring, steady Eddie. What's actually happening is artificial intelligence data centers require so much power that actually utilities are actually reporting much better earnings or expected to report much better earnings because they're having to generate so much power because of the demand for power being generated from the data centers deriving artificial intelligence. So it's actually ironically funny, if you looked in a lot of the thematic artificial intelligence ETFs, none of them have utilities listed, but yet utilities as a sector are actually benefiting from the artificial intelligence kind of phenomenon or momentum. And so it's starting to become almost a part of the infrastructure, a part of artificial intelligence. To your point on kind of the sector rotation and what sectors of the economy are starting to benefit.
Yeah, absolutely. Yeah, so that's where sometimes it can feel like it's been so good. How could the rally continue? But in reality, it's been very good in a small portion of the market. And if you think even on the sector level, you got, I think real estate is still negative year to date, but you've got a bunch of sectors that are only up single digits. So there's a lot of opportunities to find opportunities within sectors, even in places like small cap that have not
market capitalization. Yeah, negative. Russell 2000, you said, is negative on the year, Christian. Is that correct?
It was a day or two ago. It's right around flat or negative right now. So,
yep, that's another area similar to this slide that shows the 493 stocks outside of the Super 7 expecting the Magnificent 7 expecting to catch up and eventually even surpass earnings estimates. Small caps are another area where when you look at earnings expectations for the remaining of this year and into 2025, there's another area of the economy that's expected to accelerate their earnings growth to eventually reach and even potentially surpass large cap. A big part of that, to your point, coming from interest rates, right? So the expectation that interest rates would stabilize and even start to come down. Small cap companies tend to have more debt on their balance sheet. If you look at the debt to equity ratios of small caps tend to be higher than large caps. So they tend to benefit from lower interest rates. So that potentially is a catalyst as interest rates start to come down. So to your point on just, lots of broad areas of opportunity, even international equities, non-US developed, so Europe and UK in particular, those companies are trading at the lowest discount to US large cap companies going back to the 60s. They're trading at almost 65% discount of the large cap US companies. And if you look at the European Central Bank just cut rates, right? And we're starting to see accelerated earnings growth in some of those non-US companies. So to your point on just a broadly diversified portfolio to take advantage of all these opportunity sets where there's still a lot of opportunity in the market that's kind of being forgotten about because of the headlines on the Super 7, so to speak, or the Magnificent 7.
Yeah.
One of the things that I think has driven not only this concentration of performance is the expectation that whatever interest rates do, artificial intelligence, these companies can kind of grow through if interest rates start to remain higher for longer. And that's been one of the bigger changes in the year to date kind of expectations or year to date thinking of the market is just, hey, we thought interest rates were going to be cut. If I go back to a second for this slide, everybody thought interest rates going to be come down throughout the year. The reality for 2024 so far is really in this slide. This shows the market implied probability of, and in particular, what I've circled here is the current Fed funds rate is around 5.25 to 5.5%. This shows the probability of at the July 31st Federal Reserve meeting of this year. So it has yet to happen, right? But you can actually go out and look at what's coming down the road, what the market implied probability is of in July at the July 31st meeting. What's the probability of interest rates of the Fed funds rate still being 525 to 550 basis points or 5.25 to 5.5%. And so in lockstep with this slide, right? So you can see in January 2024, it was almost 100% that we thought we were going to have lower interest rates. And that matches up with the probability that in January of 2024, coming into this year, there was essentially a 0% probability. The market thought there was no chance that come July 31st, we would still have a Fed funds rate of 5.25 to 5.5%. And you can see pretty much in one picture, this is what the story of the year has been, of that we've just seen a continued increase in the probability to the point where now we're almost at 100% probability that in the next Federal Reserve, there's going to be no change. So those interest rates will stay where they are at 5.25 to 5.5%. And the big reason, yeah, go ahead. Yep.
That's really what's encouraging to me about this year is if you would have asked someone, what's the bull case for the market in the fourth quarter of last year? It was, we're going to get 6 interest rate cuts because the economy is going to weaken. And the Fed will help us out. And that's what will cause stocks to rally. But in
100%.
actuality, what's happened is economic data has been more positive. Earnings have been stronger. The Fed hasn't needed to cut. up until now, at least, and we've still had a 15% rally in the S&P. So that's a much more encouraging reason to be rallying, because economic data is better than expected, so the Fed hasn't had to cut.
I could not agree more. I mean, getting back to the point around, at the end of the day, earnings are what drive equity prices. Couldn't agree more. And what's exciting at the same time, kind of talking to what, showing to what we were just talking about in terms of market concentration. Here we are 6 months into a year, interest rates haven't budged, the markets are up 15%, and there's still just so many areas of underappreciated opportunity yet to come that will still benefit for eventually when inflation does get to kind of where it needs to be. We do start to see potentially, an interest rate cut or two later this year, maybe into next year. There's still lots of untapped potential in terms of the market and the economy that can still kind of move higher, to your point. Because if you had said, hey, interest rates are not going to budge and the market's going to be up 15%, like that would have been a low probability event. But here we are, I think, given to that concentration issue that still has a lot of opportunity. But I think the key story that into why that change in kind of outlook for interest rates is shown in this slide here. This is just a time series. This is the 3 month, essentially think of this as the 3 month moving average of core PCE, which is one of the key inflation measures that the Federal Reserve uses in order to gauge what they want to do with interest rates. So core refers to they remove the effects of food and energy from PCE. PCE just stands for personal consumer expenditure. So it's just kind of similar to the cost of the basket of goods that people are buying in regards. But this is a key measure of inflation alongside CPI, which a lot of people are familiar with as well. But in particular, what's been the focus for Federal Reserve and policymakers is the most recent trend in this data point. So they look at the most recent 3 months and say, okay, if we experience the most recent 3 month rate for the next year, what would that look like? That's essentially what we're doing here, is the 3 month rate annualized. So pretend the 3 month is 1 year. And in particular, you can see as we it started to come down through 2022 and 2023. And as you start to get towards the end of 2023, we even hit that orange line across as the Fed target of 2%. That's where the Fed wants to get inflation to on a rolling basis, is that 2% target. We actually even hit that target late in 2023, which is what led to, hey, we're already at the Fed's target, so they can start cutting interest rates. And then what changed is we have seen and experienced a reacceleration in the rate of inflation coming out of the gates in 2024. And that's what caused the Fed to just like, oh, wait a minute, hold on, it's starting to reaccelerate. What do we want to do here? And thankfully, the most recent the couple of data points that we've gotten, we've seen that rate of inflation starting to tick back down. But we want to see a more sustainable rate of decline. But this picture in particular kind of tells the story of where the expectations change came from the beginning of from the end of 2023 to where we are today, and why there hasn't been an interest rate cut to date because of this reacceleration underneath. And really all of that coming from this, which is labor costs. Wages in particular, because of tight labor markets, which you continue to hear about, in particular in the services sector of the economy. So if you looked at a decomposition of both the CPI, the inflation, and PCE, what's happened is much less goods and much more services. So you think about auto insurance, if anybody's paid for their auto insurance bill recently or had to renew, auto insurance prices are up through the roof. Travel and leisure, healthcare services. The services portion of the economy, which are dominating the inflation landscape, the cost of those services are really starting to have been accelerating, all because of the wages underneath. The biggest cost component for those services are usually wages. And you can see this just tracks the employment cost index in the United States. And it's just been ticking up because of the labor shortages and the supply demand imbalance in the labor markets, in particular services sector. That's really what's been driving the accelerated inflation. So let me stop there before we kind of go, okay, here's where we kind of are. This has been the story before we kind of look at what we're watching going forward. Let me just, any kind of questions or thoughts from you guys, Christian, Austin, anybody, or anybody on the line?
As you know, we don't have a problem interrupting you, so
Nope.
we'll let you
Cool.
keep going now.
Keep going, yeah. And I'm watching my time because as everybody knows, and you guys know, once I get going, I don't know how to stop. So I want to make sure we have time. But I'm going to fast forward to kind of related to labor. The biggest thing that we're focused on right now, that I'm focused on right now in terms of how this all starts to play out, is actually the labor markets. And I show this chart because, or this table. This table shows, going back to 1967, The period of time on average it's taken from when the Federal Reserve just starts to raise interest rates. So basically the first Fed hike, or when interest rates dropped, to the period of time when we start to see an increase in unemployment. So when the unemployment rate drops. So essentially it's, for us, we've just moved into the average period of time when we would expect to see unemployment start to tick up, which actually in the most recent employment report we did. We went from 3.8 to 4. So the first Fed rate hike happened in March of 2022. Fast forward, on average, if you go back to all the periods from the first hike to when unemployment rate starts to increase, going back to 1967, the average period of time it takes for that to happen is 23 months with some dispersion around it. So we had the first Fed rate hike in March of 2022, call it 2 years later, March of 24. And so now we're kind of 27 months into it, and we are starting to see unemployment start to tick up. We've seen, and actually you can see it right here in this slide here. So this is job openings, which are something are always in the headlines, kind of job openings per unemployed worker in the US. And so as you can see, we started to see a steady decline in that ratio. So job openings, the number of job openings has been coming down. At the same time, the number of unemployed workers has kind of remained relatively consistent. So job openings are starting to decline first and foremost, and unemployed workers are starting to remain flat. So that's bringing that ratio down. Still not recessionary by any stretch of the imagination, right? If anything, we've just gotten down to pre-pandemic levels when the economy was still doing very well just before the pandemic. But we are starting to see a loosening up in those tight labor conditions, right in lockstep when we would expect to see unemployment start to tick up or labor market start to ease up, given the timing of the first Fed rate hike in March of 22. So we're about 27 months into that. So now for me, the big thing is, okay, going forward, what happens to that labor market? Does it start to deteriorate faster than we expect, or does it kind of start to slowly ease up? In addition to job openings starting to come down, we are starting to see initial jobless claims. The 4-week moving average of initial claims has started to tick up as well. And then we're also starting to see the non-farm payrolls numbers have been stable, but they haven't started to increase yet, but they've kind of been stable. So we're definitely starting to see the beginnings of a labor market starting to ease up. What we haven't seen though yet is a decline in average hourly earnings. So wages are a huge part of kind of the labor and consumption equation, but just the condition of the labor market is probably the biggest thing that I'm watching now going forward in terms of how that shakes out with each unemployment report. The next one will come in just a couple of weeks when we'll get the July non-farm payrolls report. But the labor market as it relates to policy is a big one. And then why the wages and why labor, all, in terms of consumer confidence, wages, labor, all play into the next big one that we're watching closely, which is consumer spending. In this case, this is a chart of just nominal consumer spending, so just that's inclusive of inflation. But you can see, going back to early 2022, we've seen a steady decline, for good reason, a steady decline in consumer spending as post-pandemic, immediately coming out of the pandemic, we saw all kinds of purchases, pent-up demand, if you will, for not only travel, leisure, goods, et cetera. And so we've seen a steady decline in consumer spending in the last couple of years, which has helped ease up inflation. And right now, we're actually in a normal range of kind of 3 to 6% year-over-year growth in consumer spending that we consider, hey, that's right in line with good economic growth, not looking for a recession, but not causing a lot of inflation either. And so we're right in that sweet spot now. Going forward, the trajectory of consumer spending will be a big variable for us in terms of, okay, is it rolling over too much? So that consumer spending, which is roughly 70%, 68, 69% of overall economic growth, that consumer spending level is something that we're watching closely. And it relates obviously to people have a job, people are getting a paycheck that they feel good about, they're confident they're going to have a job tomorrow, next week, next year. They're out spending. That tends to be highly correlated. And consumer confidence has been kind of stabilized as well. So the labor market, as it relates to consumer spending, is probably the one or two biggest things that I'm focused on in terms of how the economy plays out as inflation kind of comes back in, the proverbial soft landing, if you will.
And a little bit of softness in the labor market, like you showed in the last slide, can be a positive for inflation. And if
Totally.
if it's not triggering the SOM rule or some of the sorts of things that can make you really worried about a recession, it can be a little bit positive because you think about what happens when there's 3.5% unemployment and there's two workers for every job and that sort of thing, or two jobs for every worker. That's going to give the worker a lot of ability to negotiate pay. You're going to see real wages go up, all that sort of thing that can be a little bit inflationary. So a little bit of softness in and of itself isn't bad, but.
No, completely agree. Completely agree. And that's why, an easing up in the labor market actually is I view as a positive for the inflation backdrop that we're in right now, that to help ease inflation come back down, all related to wages. And to your point, in terms of where we're seeing the tightest part of the labor market is more in that services sector, but the lower income workers in the services sector tends to be where the labor market is tightest, and that's what's actually generating a lot of the upward pressure on both wages and inflation. But if that's the consumer spending, that's the consumer side and labor side, I'm actually very optimistic on the corporate side, which is you're starting to see CEO confidence has been improving consistently. So this is something that we look at and track. So the number of times that a CEO for an S&P 500 company will mention the word recession or talking about concern over a recession on one of their earnings calls, this goes back about 5 years. But you can see as of the first quarter earnings season that we just got through in the first quarter of this year, we're back near kind of all-time lows in the last 5 years. So CEOs are actually getting more confident that we're not going to experience a recession. Growth is hanging in there. Growth has been much more persistent and resilient than anybody could have expected. That gives them, and just like a consumer, when they're confident, they feel better about the future. They tend to do share buybacks. They tend to invest in CapEx. They tend to hire more workers, which all starts to kind of percolate in terms of continued economic support. Never mind the fact, you remember, go back to the very beginning, we talked about the broad opportunity that still exists in the 493 companies in the S&P 500. So we have more and more broad CEOs feeling better about the economy to spend. That starts to unlock that opportunity that's pent up outside of the Magnificent Seven. And ironically, maybe not ironically, they actually have very good cash balance sheets to do it. So this shows the amount of cash held on corporate balance sheets is at an all-time high going back to the late 90s. If you think about the amount of debt that was issued at very low interest rates for relatively long periods of time by larger corporations, that's allowed them to generate a lot of free cash that's now just continuing to build up on their balance sheet. So rock solid balance sheets, cash to put to work, and their confidence is increasing. This is another area that I'm excited about as the pressure comes off of the consumer and the pressure comes off of the government to spend, which we'll touch on in a second, right? Corporations can pick up the baton, and again, capital expenditure, jobs, share buybacks, et cetera, all very supportive of equity markets. So kind of continuing to watch this play out. If there is one area that I'm also watching closely, and maybe more in a concerning way on the corporate side, it's probably on the debt maturity profile. And I can't remember, maybe we've talked about this in the past, but this slide shows in blue this is particular focuses on the high yield debt market. So oftentimes smaller and mid-cap companies are issuing higher yielding debt, as opposed to larger, more established companies are issuing investment grade. So, but the high yield debt market tends to be a canary in the coal mine for how the overall economy is behaving and how markets are behaving. So if you look at in blue is the percentage of high yield debt that was issued by year. So no surprise, tons of debt was issued in 2019, 20, and 21 when interest rates were virtually, I don't want to say zero, but they were very, very low. So they're issuing that debt at attractive rates, which makes a ton of sense. The issue with high yield debt as opposed to investment grade tends to be longer maturity. So it tends to run out 10, 15, sometimes 30, 50, or 100 years. High yield debt tends to be issued more around 5 years in terms of maturity, which is why you see in purple, the maturity profile. So when this debt starts to mature, starts to happen in 2025 and really ramps up 26, 27, 28. In addition to high yield being from small and mid-cap companies, a lot of commercial real estate debt tends to be shorter term, right? So that's also kind of grouped into the higher yielding debt market. So commercial real estate, office, multi-residential, high yield, we have a lot of debt coming due in the next couple of years. So as interest rates persist, what I'm watching for is, do we start to see an acceleration in defaults? So if companies that have issued debt at very low attractive interest rates, not to mature, and they have trouble refinancing, or when they do refinancing, it's all of a sudden their cost of capital jumps 5 or 6%. Do they have trouble meeting the covenants? Do they start to trip covenants? We start to see defaults pick up. That tends to be a sign of more systemic issues. So far, defaults have not budged. They continue to be at multi-decade lows. Interest rates, credit spreads are extremely compressed. But going forward, especially 25, but in anticipation of 26 and 27, as you see this maturity profile pick up, what we're looking for is any kind of volatility in credit spreads, and then any kind of acceleration in defaults as kind of a sign of things to come. But so far, so good. Another one, and this probably leads into some of the more interesting topics I'm sure we'll hit on, the fiscal situation in the United States. Not in the United States, I'll say even a lot of the developed world, but this chart just shows in the top half of this chart, this is the percentage of, essentially think of this as government revenue. So it's percentage of government receipts, which is all the receipts in terms of taxes, corporate taxes, personal taxes, income taxes, government revenue. What percentage of government revenue is being paid out to just service our debt? So the net interest payments of our debt. And probably no surprise, if you look at 2022, it's skyrocketed to be equivalent to where we were back in 1995, 1996. A lot of that has not only happened as a result of not so much more and more debt. Actually, the amount of debt outstanding has gotten slightly better in the last year or two, but the interest being charged on that debt, because the government debt's being funded at the short end of the curve, kind of 3-month, 2-year, those interest rates have skyrocketed along with federal interest, along with overall interest rates. And so the interest that's being paid on that amount of debt has skyrocketed. So how that plays into now that we start to see a crowding out effect in terms of government programs and the ability for government to support various types of initiatives, defense spending, whenever, what have you, starts to get crowded out because we're spending at this point 17, 18% of our revenue on just servicing the debt that we've issued. Similar to that, the amount of debt overall in relation to our GDP, we're now running, close to 120% debt to GDP. That starts to look more or less like a Japan, all still serviceable, so to speak, but the fiscal landscape, the fiscal backdrop going forward is one where at some point, we'll need to do something one way or another. But that fiscal situation, how it impacts not only taxes, but also government spending. Should we go into a recession in the next year or two? Unlikely, but if we did, usually government spending increases to support that, right? We don't have a lot of room for additional fiscal spending if we do start to see growth slow down and become recessionary because of where we are in terms of the amount of debt issued post-pandemic, or pre-pandemic, I should say.
So when, and I think that the debt can always be we hear about it in the headlines a lot. It can raise a lot of people's blood pressures. But when you think about what are the risks of if we remain very elevated in our debt to GDP, if our cost of servicing debt keeps going up because we have to keep issuing debt at higher interest rates, would you maybe paint a picture of how worried we should be in the short term versus intermediate versus long? There's obviously the risk of crowding out. So the idea that the government can't spend as efficiently because they're having to spend so much of their money on just simply servicing the debt. But right. How worried should we be, and maybe even what type of effect will just a higher debt have on equity markets or fixed income markets?
Sure. Yep. My thought is the short to intermediate, the short to medium term, not a lot of risk in that the global financial system, for better or worse, and I know we've heard, what happens if the Chinese start buying our treasuries, or we're seeing lower foreign ownership of U.S. treasuries. If you look at the ownership profile of U.S. treasuries, it's remained relatively consistent. China's come down a little bit, but by and large, U.S. citizens and the U.S. government itself is the biggest buyer of treasuries. And with baby boomers retiring and continuing retiring, looking for income, and where treasuries are right now, I don't expect that ecosystem to change in the short to intermediate term, where U.S. treasuries continue to be the risk-free asset, the risk-free security in the global financial system. And so much of the rest of the world's lending and credit are set off of the U.S. treasury. If that were to change, it's something that happens at a glacial pace. So that's why I say short to intermediate term, I don't see that ecosystem changing. Long term, I think if at some point the United States, we as a country, don't do something to rein in our fiscal backdrop and get this back down to something that is more manageable. I think longer term, there is the potential for inflationary effects. So usually there is somewhat of a correlation between long-term fiscal deficits and inflationary forces, because one of the ways the government can try to bring that back down in is to they let inflation run a little bit higher than they would normally like, because it inflates or deflates, I should say, the real value of that debt. So you actually start to make your debt to GDP ratio look better if you let inflation run a little bit higher, because your debt has been issued in nominal terms. In addition to that, a lot of times if inflation's running higher, people who are investing in the fixed income markets on the longer end of the curve, 10-year, 30-year treasuries, they start to demand more of a term premium to be compensated for the long-term effects of inflation. So historically, the difference between the 10 and 30-year treasury term premium, if you will, has been about 50 basis points. If we start to continue to let the fiscal situation continue to deteriorate, all of a sudden people might be starting to look for 75, 100, 150 basis points a spread to compensate them for the inflation risk that comes with compounded inflation over a longer period of time. And then obviously the crowding out effect in terms of government spending. For better or worse, you take the pandemic as a massive example of government spending on steroids. When economic growth is recessionary and is plummeting in the case of the pandemic, government spending historically has been one of the areas where we could prop up economic growth in order to get through a recessionary period. And then normally, and this is what's concerning about this period, is normally when you start to run solid economic growth, 3, 4, 5% like we have, that's when you want to start to see the fiscal backdrop start to improve, because now we don't need to run those fiscal deficits. We can actually start to save for a rainy day. If growth rolls over, then you let your fiscal deficits kind of get ahead of itself in order to support growth and bring it back in. So now, if we start to see recessionary type warning signals go off, that's what concerns me the most. If there was a concern in the near term, is like we don't have a lot of fiscal room other than to let this really get out of control. But short to medium term, relatively limited risk, because I don't see that treasury dynamic changing. But longer term, we do need to kind of address it somehow, way, shape, or form, which is probably going to be in the form of taxes, tax increases. So clients that are on the phone, if you're not already best friends with Christian in Austin, like, make that quickly. So think about the best ways to make tax efficiency your friend, because I do think taxes will be going up, and other places. And inflation probably sits in this kind of 3% range for a foreseeable period of time. Probably the topic we haven't hit on yet, that's probably on the other minds, and we've kind of danced around it, is the presidential election. This slide. So I wrote the bullet point in the bottom is something I wanted to get on there, so I don't remember, so I never forgot it. It's actually 2024. Obviously, the U.S. election will be the milestone event coming in November. And this chart just shows the annual S&P 500 price performance in presidential election years going back to 1952. And by and large, and I have seen so many research projects sliced and diced every possible way, looking at presidential elections when the Republicans have majority, when the Democrats have majority, when there's you name it. By and large, there's really no impact, longer term trend in terms of what politics look like in the United States to market returns. The biggest determinant of what market returns will be in any kind of presidential year, and you can see it here, is if there's a recession or not. And that's really divorced from a presidential election. It's more the impact on earnings growth what determines if there's negative returns in a presidential election year. Other than that, the biggest thing that a presidential election can do for markets is just come and go, so that we get the uncertainty kind of past it. But beyond the U.S. presidential election, 2024 is, and when I heard the stat, it kind of floored me. 2024 will be the biggest geopolitical event year in recorded human history. So 40% of the global population will experience some sort of election. 70% of the global market capitalization of the entire global economy will have some sort of election, and 60% of global GDP. And you're probably already starting to see headlines. So earlier in June, Mexico elected the first female president. India, they had elections April through May. They maintained their prime minister, Modi. UK election was going to be happening, ironically, on July 4th. The French elections, we're probably seeing headlines on most recently. June 30th and July 7th, we'll have French elections. And then obviously the US election on November 7th. There's elections throughout Asia as well. So it's just a massive geopolitical event in terms of political elections and political turnover, if you will, in the US election, barring none. But in terms of, and I'll end here, in terms of a trend within a presidential election year, this chart, I think there's a lot going on here, so I'll walk through it, but I think it does a good job of kind of what to expect from here going forward. This looks at, in all the presidential election years going back to 1928, this chart takes the rolling 3-month period. So January, February, March, and then February, March, April, May, June, et cetera, et cetera. So that's what's going from left to right. Each of those bar charts shows the average return in that 3-month period going back to 1928. So from January, February, March, going back to 1928 in a presidential election year, the average return of the S&P 500 in those 3 months is about little less than 1%. And it's the percentage of positive months or positive periods in all election years is about 60. That's the number at the very top, 60%. So you can see, by and large, in presidential election years across the board, markets are generally up anywhere from 50 to 60% of the time. What's interesting is, if you see the big green bar chart in the middle of this slide, we've now just entered. So June, July, August is historically the best 3-month period for equity market returns in a presidential election year, with an average return of 7.3% in June, July, August, and a positive return 75% of the time. Probably right behind that, or right next to that in terms of order of important takeaways from this picture, as you get closer to the election, so in particular, you can see those 2 bar charts in red. So August, September, October, November, so the real run up to the election, you start to see still an average positive return for those 3-month periods, but you can still see, but much less probability of it being positive. You start to see more uncertainty, more unknowns, more volatility start to pick up into the market from kind of end of the summer into the election is when you'll see just more uncertainty, and you'll see more volatility in the markets. But and again, back to my most important point of an election is just getting it over with. As soon as the election's over, now we've removed that uncertainty. We get a better sense of what policy is going to look like to some extent. We get a better sense of what Congress is going to look like to some extent. And so you start to see the average returns for the rest of the year start to pick back up as soon as the election's done. So that's what I would say is the election, we'll expect to see volatility going into it. And the last thing I'll say on the election, regardless of kind of wins and probability, et cetera, I think and related back to our talk on the fiscal situation, I think the biggest thing that nobody's talking about and related to the US presidential election is, in 2025, there's a fiscal cliff of $3 trillion that is coming no matter what, that happens and occurs with the expiration of the 2016, 2017 tax cuts. So those expire. There's a $3 trillion fiscal deficit that somehow has to be closed in fiscal year 2025. Irregardless of who's in the office, who has majority, who has minority, that has to be dealt with in one way or another. I think that's the biggest thing that people should have in the back of their minds as it relates to the election and how we're going to address that, what it could mean for income tax rates, what it could mean for estate tax. Already in 2026, we're seeing the estate tax exemption cut in half. Things like that start to come quickly into focus as you get past the election. So that's the last thing I'm going to say. I'll stop there. And as usual, I've gone on too long and said too much.
That's good. And just to reiterate how unusual this chart is if Steve would have put up a chart of the seasonality any other year in a non-election year, it would look totally different. So
right. Totally.
The summer, if you've heard the phrase sell in May and go away, typically the June, July, August months are not the strongest for the stock market, but it's this election cycle that's very different. And then similarly, those 3 months leading up to the election are much weaker in election years than in other years. So,
yep, absolutely.
And so does anybody have there's no questions on there right now. Does anybody have any specific questions? Maybe one I'll ask real quick that I get a lot now, since you hear a lot of fear commercials on the radio and things involving gold and silver. I'm going to go ahead and bring that up. Though
Sure.
honestly, I've got people that ask me about that sometimes, but honestly, a majority of people don't bring it up. But I think it's good to address because we hear so much about it in the media today. So, any
Totally.
opinions on gold and silver, maybe primarily
Yeah.
gold, Steve?
Absolutely. So I'll speak to the qualitative impact of gold and kind of the behavioral aspect of gold, and then some of the fundamentals that I've been reading about in research on gold in terms of supply demand. So I do it some no matter what, I always try to come back to, okay, what are the fundamentals of whatever asset class we're talking about, be it fixed income, equities, commodities, whatever it might be. What are the fundamental drivers of that? In terms of commodities, it's really supply demand. The demand for gold can be driven by sometimes some of the more behavioral aspects. So when you do start to see geopolitical tensions pick up, et cetera, that usually tends to drive demand for gold, and that's what we'll be seeing. But by and large, the relationship that when I think of gold and I observe its behavior, and it's kind of been lockstep for the last probably 10 or 15 years, gold tends to be a good proxy for real interest rates. So said a different way, when gold tends to move higher, when investors in the markets are broadly concerned that inflation is going to start to get ahead of monetary policy. So if the Fed is behind the curve in relation to inflation, or that's what the markets are perceiving, that's when gold tends to do well. And that's why you saw gold go on a tear earlier in this year, because everybody thought the expectations were, oh, we're going to see 6 or 7 interest rate cuts at the same time that inflation was starting to reaccelerate. That's when gold made a majority of its tear earlier this year. And if you've noticed, gold's kind of flatlined and even been flat to down the last couple of weeks, really since there's been a change in tone from the Fed around, yep, actually, we're going to keep interest rates higher until we get clear signal that inflation's contained or coming back down. Gold has been flatlined. That relationship, by and large, is kind of what drives much of the gold behavior in terms of inflation relative to monetary policy. In terms of the fundamentals, I'll say this. I have been reading ahead of so much of the political elections that are coming up globally, and especially since the nationalization of the Russian central bank's assets in the United States. Central banks actually have been picking up their purchases of gold to have in their reserves against their currencies. So a lot of the demand aspect has been driven by central banks' purchases of gold for their own reserves. That's expected to continue through the rest of this year, which probably puts somewhat of a positive underpinning to gold for the rest of this year. But should interest rates remain relatively high and kind of now we only expect to see one interest rate cut, I don't think gold goes on a tear unless something dramatically changes in terms of that inflation policy dynamic.
Yeah. One other challenge I've seen just practically that people have with gold is gold can do well during like Steve was saying, a geopolitical event. There's some heightened volatility event. Gold can hang in there. So I think a lot of times people will try to buy gold ahead of an event where it feels like there's going to be some sort of geopolitical shock. I think the challenge is knowing when to unwind that gold position. So I see a lot of people buy, and then either the event doesn't materialize or it does, but then eventually things get better and you're still stuck holding gold 2, 3, 4 years later when things have, it's the same thing as if you want to sell, if you want to get out of the market, you have to know when to get out of the market and when to get back in the market. And so very rarely, but occasionally we've seen people time it perfectly and go to cash right before some sort of big negative event for the market, but then the ability to buy back in, well, you have to buy when there's fear and everything's wrong and unemployment's high, and then that's the really hard thing to do. So I think the same behavioral thing happens there with gold sometimes.
Yep, agreed. I tend to use gold as a long-term inflation hedge in portfolios, and in particular, gold reacts the best when inflation is surprising to the upside. So like what we saw in 21, 22, gold and commodities broadly were the best performing assets on the planet, right? When people think inflation is going to be 3 and it comes out at 4, and then expectations are for 4 and it comes out at 5, when inflation is surprising to the upside, that's when commodities are lights out the best asset on the planet. But those times are few and far between, right? So I have it as a relatively smaller allocation as an inflation hedge, exactly to your point, Christian.
And then we had a question on bonds, which are going to be somewhat interest rate dependent. But I thought maybe, Christian, you could hit real quick how we are on duration and quality in the latest rebalance. Then maybe Steve talked to his opinion on bonds too, just because people don't get that. They only hear us
Totally.
talk.
Sure. Yeah. So, I mean, when you think, Steve earlier was talking about the term premium. So what that means is that typically if you buy bonds that are longer duration, if you buy a 10-year bond, you should get a higher yield than a 2-year bond. But right now, the yield curve is inverted. So that's not actually the case. And so you can actually get more yield buying shorter term bonds. And so one, if you're just looking to buy a bond to get the maximum yield, that's actually on the short end of the curve, which is somewhat unusual. But also, there's a lot of opportunity here if at some point, say we have a recession, or if at some point just inflation is moderated a little bit and the Fed is able to cut rates a little bit. There's a lot of opportunity on the short end of the curve. So the aggregate bond, if you just think about like the S&P 500 of bond indexes, its duration is somewhere in the 6 to 6.5 year range. We think there's a lot of opportunity being shorter than that, and there's the opportunity for outperformance, one, by picking up yield, but two, if rates do go down on the short end, if interest rates go down, the price of bonds go up. So there's that opportunity to stay on the short end of the curve, pick up yield, and potentially even pick up price return. So that's where we've been for a while now, is owning much shorter bonds. We own a little bit of the long-term stuff. Just, there's opportunities if we did have a full-scale recession or something like that. But we're primarily concentrated on the short end of the curve. And that's where you can also own, money markets or high-yield savings accounts. And there's nothing wrong with that. And we do own those. But the difference there is if you own a money market and rates go down, your money market rate, if the Fed cuts rates, your money market yield is also going down with it. Now, you didn't lose money. It's still, the principle's untouched. But, you're a 5% money market. If the Fed's cutting, might be 4.75 or 4.5. Whereas if you own, a 1-year bond, that interest rate, you have a fixed interest rate on the bond that you bought, but also the price of the bond could potentially go up as those interest rates out there are going down. So that's kind of the way we're thinking about it right now, kind of staying more in the short end of the bond curve.
Then Steve, do you have any opinions on bonds? Since we'll get your opinion while we got you here.
Yeah, no, well, I could not agree more. We're in violent agreement, Christian and I. And that I think there's if you look at the longer end of the curve, the 10-year and 30-year, there's fine, you're getting 4% yield, but you're getting the same, if not more yield, the shorter end of the curve, as you said. And then you have a call option on when interest rates do get cut, it's going to be the short end of the curve that moves down. And so you get that capital appreciation. So completely agree. A lot of other questions I get from clients and advisors is, I'm concerned about inflation. I hear about inflation. Bonds went down in 2022, so I shouldn't own bonds. What I've been saying in kind of articulating is the bond market today going forward, it could not be more different than the bond market at the beginning of 2022. Because you have essentially a built-in buffer, you have a built-in cushion in terms of the yield that bonds are paying today of 4 to 5%. If you go back to 2021, bonds were literally like the 10-year was below 1%. Like you had no cushion. The only analogy I make is for people who have had the fortunate or unfortunate experience of having a knee replacement, right? Bone on bone. Like there's no cartilage in a bond if interest rates move up or down when there's no yield being paid. And that's where bond markets were at the beginning of 2022, which is why 2022 was so painful, because we had interest rates move up by so much. At the same time, there was just no buffer whatsoever built in because there was no yield. Fast forward to today, that pain has been taken, better or worse, the pain's already been taken. So now going forward, you have 4 to 5% buffer built in. In order to have the same experience that you had in 2022 in bond markets today, interest rates would have to go to like 14 or 15%, if not higher, in order to wipe out that whole buffer that's been built into bonds. So, and if anything, we see inflation's flat to coming down. We're getting ready to cut interest rates. So now to be able to pick up 4 to 5% in the fixed income markets in the treasury, never mind, close to 6 or 7% in an investment grade corporate bond, those buffers, it's completely night and day in a good way compared to where the bond market was at the beginning of 2021 and 22.
That's what so many of you heard me say so many times when you're meeting with Hunter or Laura or I, the opportunity in bonds moving forward. It's a totally different environment than it was in 2022. We actually have yield now compared to the COVID lows or whatever, where there was just no yield at all. So lots more opportunity moving forward and lots more cushion and the opportunity to be defensive that we didn't see a couple of years ago. So feeling pretty good about that. So
Yep.
I don't see any more questions on there right now. We've gone a little bit over an hour, but thanks again to Steve for being here. You know, we're incredibly lucky to have such a deep bench at Integrated, and even having Christian, our own CFA in house. I know I've said it before. I really believe he's the only CFA in St. Joe here locally. So for those of you that are local, I know we got several that are around the country on the call as well. But he's a great resource to have in house, and then to have the Integrated team behind us. So we appreciate y'all being here. And any closing comments?
It's always fun. It's a great time. I always enjoy getting together with both of you, your clients. I look forward to doing the next one.
Sounds great. Thank you all for coming. And if you have any follow-up questions, let us know. We're going to try to make a recording available too. So we'll talk to y'all later.
Thank you all.
Thanks.
Take care, everybody. Enjoy the summer.
Okay.